In this video, we're going to talk about the cost recovery method, which is a means of recognizing revenue when there's considerable uncertainty, similar to what we talked about with the installment sales method, but we're just going to calculate things a little bit different than the installment sales method. So with the cost recovery method, we're not going to recognize any profit until the amount of cash that we've collected exceeds the cost of the item that we sold. So if it cost us $10 for that piece of inventory, we're not going to recognize any profit until we've collected at least $10. So let's jump into an example. Let's say that you sell some inventory that cost you to purchase $100,000. You're some kind of organization, you're a retailer or something like that. It's cost you $100,000 and you're going to sell it for $140,000. Now normally you have profit here of $40,000. So we just take the $140,000 sales minus the $100,000 cost of goods sold, and that gives us $40,000. And you are going to have $40,000 of profit. However, because there's uncertainty about whether you'll be able to collect this and you're not able to estimate what the collection rate will be and so forth, you're going to use this cost recovery method. We're going to say, look, I'm going to only recognize this $40,000 once I've collected at least $100,000 in cash. The reason is you want to first cover your cost before you recognize any of this profit. So let's think about it like this. Let's say this was 3 years. This was 2019, 2020, and 2021. And these are your cash collections right here. And we're basically saying that the first year, let's say you made the sale in 2019, you collect cash of $75,000 in 2019. So we look and we say, okay, wait a minute, let's go back to our decision rule. The cost of our item sold, have we collected at least that much cash? Well, our item cost us $100,000. That's what our cost of goods sold is. So have we collected at least $100,000 at this point? No, we've only collected $75,000. So our profit recognized is zero. We defer this profit. That's what we're going to do. We're going to defer it. So if we were looking at our closing entry for the year, for 2019, I'm not talking about the entry to record this sale that we've got going on here, but the closing entry where we debit sales and then we credit cost of goods sold because they're temporary accounts to get them off the books, and then the difference would normally end up going to equity, end up becoming a part of retained earnings. But instead here, it's going to go to this deferred gross profit account. And what that is we're saying, look, we're not going to have this go to earnings yet. We're going to put it in this deferred gross profit account and wait until we've collected at least $100,000. So 2020 rolls around, and now we collect an additional $35,000. So now at this point, what we've collected is $75,000, the total up to this point, plus $35,000. What does that give us? That gives us $110,000. Now we go back to our rule. Have we collected at least $100,000? Yes, we've collected $110,000 up till now. So now we can say, well, we're going to recognize $10,000. Why $10,000? Because we take the $110,000 in cash we've collected up till now, and then we subtract out the $100,000 cost of our item. So we've collected the cost of our item, that $100,000. We made that $100,000 back, and we've got $10,000 extra in terms of our cash collections that we have here. So now we can recognize $10,000 worth of profits because we've met our cost rule here. We've got at least our cost of goods sold back. So now we're going to debit deferred gross profit to decrease it. Remember over here, this was a credit that it increased with. So we're going to debit it to decrease it for $10,000. And then we're going to credit realized gross profit for $10,000. And what effect is that going to have? Well, in 2020, we're going to recognize, we're going to have $10,000 of net income, $10,000 of earnings because of this. So now for 2021, now we know that we've covered this cost of goods sold because at this point, I mean, we covered it last year, right? And 2020 is when we exceeded that $100,000 in cash collections. So now we collect an additional $30,000, right? So now we've got collected $75,000, collected $35,000, and now we've collected the $30,000. So we collected a whole $140,000. So we can definitely recognize some of that gross profit that we deferred, but we can't recognize. We're not going to recognize the whole $40,000 because we already recognized $10,000 of it. We recognized $10,000 of it in 2020, and then now in 2021 we're going to recognize the remainder, $30,000. So now we just go down and make a similar entry to what we made last year. We say we're going to have debit our deferred gross profit for $30,000, and now we've zeroed this out, right? So we started with a balance of $40,000. We decreased it by 10 last year. We're decreasing it by 30 right now. So we debit deferred gross profit for $30,000, and then we credit realized gross profit for $30,000. So let's look at the effect that this is going to have on our net income, our income statement. So the income statement, I'll just abbreviate it I/S. Here, there's no effect. There's no effect in 2019. All right, so what I mean is this transaction does not affect earnings, right? No effect on earnings. Now, in 2020, we're going to have $10,000 in earnings, $10,000 in earnings from this transaction. And then in 2021, we're going to have $30,000 in earnings. Now, let's just think back for a second. Let's say we didn't use the cost recovery method at all. Let's say that we had instead had used just regular old plain simple accrual accounting, just like a regular sale. So if we had done that, then we would have recognized all $40,000 of profit in 2019. Why? Because in 2019, that's when we made the sale. However, with the cost recovery method, we're saying, look, there's a lot of uncertainty with this sale. We can't really estimate. So what we're going to do is we're not going to recognize any earnings here because we haven't collected enough cash to exceed our cost of goods sold. We want to make sure we get that cash to cover our cost of goods sold before we recognize any profit. Well, we've covered it in 2020, so we recognize $10,000 in earnings then, right? And then in 2021, we recognize the additional $30,000 in earnings. So instead of having $40,000 of earnings recognized here, $40,000 of profit here, we have zero profit recognized here, $10,000 here, and $30,000